Let's see if our panelists are looking at any retail stocks this holiday shortened season week, I should say, right? Holiday, because we have Thanksgiving on Friday. So Brian, you're kind of running the fine line. Direct sales company is one that's on your radar.
Right, Herbalife, and this is a big story that's been throughout Wall Street over the last year. I think about a year ago, December 20th, Bill Ackman puts a $1 billion short position on the stock at roughly $40. The news of this sends the stock down to 20, but then Carl Icahn comes in, as well as Dan Loeb and a few other big investors buying large stakes. So over the course of the year, Herbalife has done nothing but regain all of those losses. Stock's now at 70. Now we're looking at the point where the squeeze on Bill Ackman is coming to a close here, because we're getting into that position where if you bought into this stock, you're going to have it in your portfolio for a year. At that point, the tax gains are different. There's tax advantages. There's talk about an LBO. So we have another investor coming in later in the year here, Bill Sturtz, who was the CEO of Post, who bought 5%, then raised his position the other day to 6.4%. If the company goes into an LBO, the stock goes up at least $20 or so, $90, no problem, possibly $100 on a squeeze, maybe even higher. But then it becomes Bill Ackman shorting the debt portion of any LBO, leveraged buyout scenario, which will then cause the banks that would be giving the money or loaning the money to whomever to give real pause to say, do I want to go bank versus Bill Ackman? Bill Ackman is a great investor. He's done very well with other things. This call, very bad, but at the same time, if he's willing to go to the end of the earth with this call, that might slow down the idea of the LBO. Still, I'm very positive on the stock. I own shares of Herbalife, and I do think it goes to 90 before the end of the year.
Okay, so nothing to do with the holiday shopping season necessarily. There's other dynamics at work here.
Absolutely. At the end of the day, it's a supply and demand issue of the stock.
Okay. Todd, you're in the insurance sector.
Yeah, StanCorp Financial is the company. SFG is the ticker symbol. Now, they're an insurer focused primarily on group insurance, group life, group accidental death and dismemberment, and group disability. And their primary subsidiary is the Standard, so people might know that name. They recently delivered their 5th consecutive positive earnings surprise, and that was driven in large part because of a lower benefit ratio. And if you think about an insurance company, they take in premiums from the policyholders, then they'll pay out benefits when they have claims. Well, the amount of benefits they paid out to the premiums they collected lowered substantially over year over year, and that's been the trend really over the last couple quarters. And analysts expect that to continue through 2013 and 14. So they significantly raised their estimates after the last beat, sent it to a Zacks rank of 1, which is strong buy rating. So very good earnings momentum here. The stock has responded. It's up over 70% year to date. But if you look at the valuation, because of rising estimates, still very reasonable. They trade at just 13 times forward earnings. The industry median is 14 times. Still some value to go along with the very strong earnings momentum here. There's something to check out here, I think.
All right, Shiraz, you have, is it an apparel company? What is this? Iconix
It's kind of a little bit of everything. They own a portfolio of brands, and then they license that to regular retailers. And the beauty of that is that as long as these brands are well regarded, and as long as there is demand for those brands, they have guaranteed minimum licensing fees from the retailers, and they are free from all the typical worries of foot traffic and leasing facilities and keeping inventories and working capital, and all of that stuff is somebody else's headache. And so they have a very strong portfolio of consumer brands in apparel, in home decor, in shoes, in all of those. And they do an excellent job of marketing, promoting, and managing this portfolio of brands. Very asset-light business model, as I referred to earlier. Very limited capital expenditures needs on a year-over-year basis, and strong cash flows, strong, consistent cash flows. I've read comments somewhere indicating that the free cash flow yield is as high as 10%. They deploy a bunch of that to buy back their own stock and buying other brands that are synergistic with the existing portfolio. Each new acquisition is directly in the near term accretive to earnings International remains a big growth opportunity for them. They hadn't had a lot of presence in emerging markets. They are making a big push in those areas. So overall, a very interesting way to play the kind of retail scene that we were discussing about earlier through a lower risk, high margin, and relatively stable operator through Iconix.
All right, interesting. Thank you for that, and don't forget to check out our website, Zacks.com, for more stock picks and stock picking strategies. In the meantime, with everyone here, I'm Terry Ruffalo.